Good Wednesday morning from the Asia Pacific. Half an hour to the opening bell, Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Choong Wilkins.
Our top stories this morning. Asian stocks track losses on Wall Street while bonds rise as a disappointing consumer confidence reading fuels worries about the U.S. economy. The so-called magnificent 7 tech stocks falling into correction ahead of those Nvidia earnings.
Now, the Trump White House is set to study possible tariffs here in copper, citing national security concerns and also pressures on domestic production.
And also ahead, China is raising scrutiny of domestic firms' outbound investments and use of funds from Hong Kong listings after record capital outflows.
And speaking of Hong Kong's set to unveil plans to reduce its deficit while tackling the impact of U.S.-China trade tensions. Again, good morning. Thank you for joining us and thank you for taking the time. Hope you're all well and rested. The midweek session, just under 30 minutes away. The downdraft we're seeing across equity markets mostly, and as you can see, Taiwan is just joining the fray, down about 0.2%. In case you missed what we just talked about, of course, ahead of Nvidia earnings, Mag 7 entering into a technical correction. That's about 10% rather. What's interesting, though, is despite the spike and all the ills and uncertainties and burdens that these markets have to discount, the VIX remains well below 20. In fact, you're getting a bit of a pullback right now, about 0.3 there of a point on VIX future. We'll talk about the data in the U.S. overnight, certainly with this drop in yields just about across the board here. With U.S. yields, I think, down for a fourth day. We should be down number 5 right now. Quite a big move down on the 10-year. Overnight. The other thing we want to point out, that we'll talk about commodities in a moment. Obviously, gold is pulling back a little bit. Copper is very much in focus today amidst the attention now being turned to Dr. Copper out of the White House. More on that in a moment. What seems to be moving against the grain has certainly been the Chinese market. So a massive move into Hong Kong markets yesterday across the stock connect. Massive amount of buying. Overnight, couple of big moves to tell you about. Alibaba's in focus, Bernstein out, raising that one to, I believe, outperform rather, up about 4%. You know, the big move in Li Auto and Trip.com was really, I guess, a follow-through from what we had on Tuesday. Nonetheless, stocks to watch going into the open today. And just looking at futures very, very quickly, and we are pointing, last I checked, up, substantially up. There we go. So it's looking like we are going to get a bounce going into the open today. We'll talk about the currency in a moment. And yeah, copper, as we talked about there, slightly higher in Shanghai on the LME, slightly higher. Well, it's not slightly higher, up about 1% on that, Rebecca.
Yes, I mean, staying close to home, we also have the Hong Kong budget coming today. Focus really there is on reducing the deficit. Of course, we've had this issue of falling revenue from land sales, declining tax revenue, and this is really the opportunity for the government to sort of propose a blueprint. Also, of course, we're thinking about how Hong Kong is going to offset some of the impacts of US-China trade tensions. Elsewhere, southbound stock connect flows. You pointed out, Dave, earlier this morning, we saw Tuesday was the highest on fourth highest on record for those flows. So we'll keep watching that, of course. Elsewhere, we have this very nice scoop from Bloomberg on Chinese firms increasing their scrutiny of outflows via the Hong Kong listing. We'll be talking more about that in the show, and also the impact for brokerages. Of course, we had this increased share sale proceeds, nearly doubling last year to 10 billion Hong Kong dollars. We've had guests on so far this year with this optimism that that's going to continue or perhaps increase. But yeah, let's see how this impacts that potential deal flow coming through. As you say, Dr. Copper again in focus, this possible probe from Trump into copper. We have this focus on national security, this focus on bringing more domestic production back home into the US. And some of those weaker numbers, speaking of the US, when it comes to consumer confidence, again, sort of really feeling their effect, dragging US markets down, and a little bit particularly for some of the speculative corners of the market. So look at crypto. Elsewhere, 7-day repo, and I'll finish up here. Really, it's the latest signal about PBOC's sort of insistence on defending the yuan here, draining the system of liquidity and the stress that's putting on. Essentially, the latest sign of a cash crunch at Chinese banks, being resistant to lend via that repo rate.
Yeah, we're going to geek a little bit further on that as well. So I'm going to raise Rebecca's repo rate, and I'm going to go with the yields on negotiable certificates of deposit.
Oh, yeah.
Take that.
Give it to me.
Well, a couple of month highs are really on the funding pressure we're seeing here. And really, that perhaps also goes into the onto the Bloomberg scoop that Rebecca was just pointing out. Now, just very quickly, as also we just touched on there with Rebecca, so this massive drop in yields and the data overnight, the conference board. So the top panel is the conference board consumer confidence, bottom is inflation expectations. The red bit you see right most of your screens is the drop of 7 points, which in terms of absolute terms is the biggest drop in about since 2021. And as you can see, that might have to do with the fact that inflation expectations have started to really move up. And, you know, tariff, Donald Trump's policies might have to do with it as well. And you know what? The economy's still doing okay, except for the Mag 7, though, where we can talk about that as well. With Irene Goh, Deputy Global Head of Multi-Assets and Investment Solutions and Head of Hong Kong at abrdn. Good morning and nice to see you.
Good morning. Thank you for having me back here. It's great to be back again.
Rebecca and I were just spending a lot of time talking about all the problems in this world. And are you surprised how stable markets have been, though, despite all these ills?
Yeah, I mean, to think about that, we've been through this volatility the last 2 years, isn't it? So since 2022, in fact. So I think a number of the investors are quite already adjusted to this new norm, perhaps, you know, of a higher volatility, whether it's in bond markets or even to some extent in some of the equity markets globally as well. But I think that's great for a multi-asset investor because of this high volatility, but still, regardless, trading in a range, just using 10-year use as an example, you're looking at, you know, a 4 to 5% range, maybe on the tights about like 4.2 to 4.7, but regardless, my point being that it provides opportunities for active investors like us to actually deliver more tactical value for our clients and the portfolios that we run for them.
Does this latest data that we've seen out of the US on, you know, losing consumer confidence, of course, we also had that CPI print that came in, you know, hotter than expected. Is that changing your narrative around the US exceptionalism story at all, or are we waiting to see kind of hard data, I guess hard retail sales, etc.?
Yeah. So, you know, there's always been the fear about, like, when does this party come to the end, isn't it? The U.S. exceptionalism story that you alluded to. We did see a bit of a bout of softness in the labor market, which is perhaps one of the reasons, along with some softer PMI services data and all, that led to this softening out in the U.S. yields. But as I alluded to, you know, there's a lot of crosswinds, the volatility market primarily being motivated by its policy uncertainty. So just the narrative of it, even without implementing it, is causing a bit of slight schizophrenic behavior in the markets. So we're still very much observing data as it comes through. But what's important to us is not just about the macro expectation, right? Whether we're going to see inflation running away, hopefully not, or whether we're going to see softer patches in GDP. It's also about market pricing. So we deliver or developed market pricing tools that helps us understand, has the market been, you know, sort of pushing a little too far to the extreme. So not too long ago, if you recall, in the last quarter of 2024, the markets was looking for, you know, the soft landing scenario, but post the Fed policy in December, that quickly unraveled, and the pricing went from one end of the spectrum towards pricing higher inflation. Right. Causes a bit of a rut in the bond market, and this presented opportunities for us and for longer-term investors to bring on some duration in the portfolio at 4.70 or 4.7% in 10-year use, just as a barometer. So the key point here being that, you know, we're able to actually use these opportunities to take on more sort of active risks in the portfolio and trade that range, so to speak. For now, the earnings picture is still pretty healthy. We're still seeing, double-digit growth in the tech space, and some of that is actually broadening out into the non-tech space, and that's how we're positioning, or rotating some of the tech or broad U.S. equity exposure into non-tech exposure. So lots to get our hands around and deliver value for investors.
Yeah, and that's an interesting point, given that, and not to ask you about Nvidia specifically, that of course is the company reporting earnings around this time tomorrow. But so the notion that, we can ask about U.S. exceptionalism in two ways, right? One is, you've mentioned you're going more equal weight in terms of a broader footprint of U.S. equities. Are you seeing yourself reduce, though, your exposure to U.S. equities as a percentage of sort of the global equity portfolio?
Yes, in some ways. We have to recognize that where valuation is concerned, U.S. is really at the top of the range. You're looking at, over 20 times price to forward earnings, as opposed to clearly China at 12 times, and even Europe and Japan are trading perhaps around neutral relative to historical norms. So from the valuation perspective, it does argue for some caution there and diversifying our investments more broadly into other markets. But all said, if you look at the U.S., where actual earnings delivery is concerned, it's still coming through stronger than other markets. So we're reducing, we're diversifying the egg, so to speak, around, or not to put all eggs in a basket, so to speak, but certainly still look at U.S. with quite a bit of interest, particularly as I alluded to, in some other sectors outside of tech, where again, valuation and so some of the earnings prospects are coming through and turning around. We also do like some of the defensive, clearly in this heightened volatility world. The probability of the tail risk scenarios, whether you're talking about a downside demand sort of falling, coming off, or a inflationary growth environment coming through, those probability of these regimes have increased. So a good hedge to that would be looking at some defensives, for instance, utilities, or even healthcare. A lot of, if you recall, over the second half of last year, particularly in the run-up into elections, healthcare took a pretty hard beating, clearly because of the Republican stance against, previously Obamacare and the Medicare, Medicaid. But if you look back at Trump's first term in around 2026, when he just took hold, took office, the narrative were quite similar. But after a quarter or two of correction in healthcare sector, subsequently in 2017 into 2018, healthcare actually, managed a pretty nice rally.
Right.
So I just want to ask, your top convictions, where does China stack up in that? And how has the DeepSeek rally, the AI rally, factored into your approach and your ranking? Yeah,
that's a good question, Rebecca. So we've been very actively playing China over the last 2 years, in fact. I think with China, it's really a case of marginal improvement in fundamentals over time. Clearly, there's some monetary tailwind, but not in a significant manner. As you well know, the government has been very measured in delivering policy stimulus. There's also an observation that the earnings growth seems to have bottomed. You're seeing it turning around gradually. So fundamentals seems to suggest that, we should be investors should be allocating, or at least considering allocating to China in a more significant way. But it's really a market where you're looking at phenomenon of taking 2 steps forward and 1 step back over the last 2 years, to my point earlier, and that allows us to actively sculpt some of these returns or this nice performance in China market. For instance, we played the reopening trade 2 years back. Early last year, we also leaned into a very significant stimulus announcement by the Chinese government, both on the monetary and the fiscal front. And currently, with the evolution of China tech and some of the positive changes and developments coming through, we're also playing that through the options market. What I'll say, finally, is that in China, it's really not quite just about being overweight China on its own. We could think about relative value of China versus the rest of emerging market. So that's also one strategy that we have actively actually assumed as well. If you looked at India, clearly the fundamentals and the long-term story is intact, but there's been quite a significant, investor positioning crowding into this market, and the expectations of earnings growth might have been a bit frothy. So, chances are that it may actually underperform China, as it did recently. Taiwan tech has also been somewhat influenced by what's going on, the volatility going on in the U.S. tech, and that may, the exuberance there may actually take a back seat as well. So, there's some optimism around China vis-a-vis its other emerging markets counterparts.
Does China remain tactical?
For now, yes.
Okay, so you haven't seen enough to make that jump between, because you mentioned India too, right? That was a tactical sort of trade, China-India, the reopening trade, the stimulus trade, now the DeepSeek trade, and I'm wondering whether we've gotten enough on the China side to finally be able to call this might be the start of a structural rally.
Yes, that's right. So the story currently is more focused on a specific sector, and what we need to see is, this consumer confidence coming through and broadening out across the economy, across the various sectors, earnings coming through as well, and more even recovery in earnings across the board. So I think those are key for us to make a statement about, well, this is it's going to be a sustainable outperformance in Chinese market. India and China in the long term, to our mind, for longer term investors, deserve a place in the portfolio. For us, multi-asset, cross-asset investors, in the short to medium term, is really about how do we tweak the allocation mix between them and try to take advantage of these ebbs and flows, right, in the next 2 quarters or so. And we've seen that transpired over the last few years when the positive news coming through on China and China performs well. The regional asset managers or the regional asset flows will tend to toggle between India and China, in this case moving their funds from India and the rest of Asia into China, and then vice versa when India comes through with a positive story. So there's lots of opportunities for us to actually play that.
Right, so still tweaking tactically and figuring out the balance between the ebbs and the flows.
Yeah.
Excellent. Thank you so much for joining us, Irene Goh, Deputy Global Head of Multi-Asset and Investment Solutions and Head of Hong Kong at Aberdeen. And still ahead, Volodymyr Zelensky said to be planning a Friday visit to the White House to seal a minerals deal that may help pave the way for a ceasefire with Russia. We'll have all the details on that story next. And we are counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. Good morning. You are watching The China Show.
Right, welcome back. You're watching The China Show. We'll take you straight back, in fact, right across the Pacific here to the U.S. Capitol, where lawmakers are still voting on these tax cuts. As you can see, of course, the vote is closed, but seems to be that this one is very much in favor of the Republicans, as you can see on your screens by simply the ballot. Anyway, we'll bring you the headlines once this becomes a bit more definitive. And yeah, we can talk about this in a moment. But yeah, lots of other things on deck today.
Yeah, a lot of geopolitical stories really for us this morning. Let's bring in Bloomberg senior editor Derek Wallbank to break the very latest. Let's start with Ukraine, Derek. I mean, we have had now this, so apparently we are now going to see this deal between Ukraine and the US. When it comes to minerals, there was a little bit of back and forth. It wasn't really clear whether or not they were going to be able to get this done. Just bring us up to speed on what we know.
Yeah, Rebecca, it looks like there's going to be a deal signed between the U.S. and Ukraine. Volodymyr Zelensky is apparently set to travel to the United States on Friday and sign the deal in person. That would be a really big strategic boost for Ukraine right now to sort of realign the U.S. relationship if they can get that done, given all of the hardships that Zelensky and Trump have had with each other. There's been a substantial amount of unease inside Ukraine and among its European allies, as both of them have been somewhat shut out of the Trump administration and Donald Trump himself's effort to re-engage with Russia. There has been a lot of disquiet about U.S. officials being unwilling to directly state Russia's responsibility for the start of the war, and a lot of fracture points beyond that, all sort of rising to the question of what level of support will the U.S. give to Ukraine for the ongoings of this. If they can get something signed, that would be a pretty big step toward. It might even be something that could help Trump convince his Republican base to allow for the continuing of help to Ukraine. And the U.S. has talked about security guarantees in the form of economic guarantees for Ukraine, but of course Ukraine needs bombs, bullets, and things of that nature, which they are turning increasingly, it looks like, to Europe for in the coming months, years ahead.
Derek, I want to ask you about copper and the comments coming through out of the U.S. president. It seems like, it's a new day, it's a new product category that's in focus now, potential tariffs. The U.S. president says it's time for copper to come home. What do we know about their plans?
Yeah, David, this one is very early stages, but copper is a new thing on there. You've seen some market reaction in there. Let me give a little bit of a window into the timing here. The order that Trump signed is very particular, that he has been asking he's asking his officials to come to him with recommendations no later than 270 days from now. That is quite a long window of time away. Certainly something could happen faster, but 270 days is quite a long window for something to happen there. There is substantial copper deposits in the United States. There's a question about production as that goes through and where that takes place, and if some of that can reshore to the U.S. So there are a lot of questions sort of related to that, and that's kind of where we're looking at here. But the time window here, I think, is particularly important, especially as we've seen in some other categories where a period of time between the announcement and the enactment becomes a window for potential negotiations. So Trump has said no exceptions. We shall see.
Okay, and Derek, I want to ask you a piece of breaking news here. I know you've been watching this vote and decision very closely, but it does look like this resolution has passed, and House Republicans have passed this budget blueprint, essentially calling for deep cuts in safety net programs. Just lay out what that means and how close we are now to that policy actually being implemented.
Well, what people should know is that this was the precursor to the one big beautiful bill strategy for Donald Trump for his agenda. Republicans needed to put a budget resolution through so that you can get, and this is very complicated, but the short version is so that you can get a second bill through that then doesn't need 60 votes in the Senate. It would only need a bare majority. So that would allow Republicans to move forward. House Republicans have wanted to do this in one shot. Senate Republicans wanted to do it in two. If Republicans in the House were unable to muscle this through, and muscle it they have had to do, it was pulled briefly, then put back on, and now it appears that they may be able to take this over the line, or may have just taken it over the line. Doing that allows for the one bill strategy to get all of the tax, immigration, energy, all of that stuff done in one. There is a lot to come on that, and there are going to be tough votes in the future. Some of the language that this resolution puts out specifies that there may need to be quite deep cuts in ways that could be politically tough. So there is a lot more ground to cover here, but certainly you have to make progress to get to that next step. There's a certain element of survive in advance, and at points in the last hour, the survive part of that strategy has been really, really an open question.
Derek, thank you so much. Fantastic to help us certainly give context here to a lot of the breaking news. I mean, it's been breaking news every day, really, if you think about it. Derek Woolmack in Singapore for us, our senior editor there. Okay, it's barely 25 minutes into the session, into the 2-hour show, and I'm already out of zone 2 on my heart rate. So hence is the new normal. As they say. We're called higher across some of the pricing right now across these markets. Hang Seng Index, Hang Seng Tech, which didn't quite get to the line at the end yesterday. Alibaba, though, did end up closing higher for the day. Looking like we will get a gap higher slightly going into the open today. Just very, very briefly, we'll go through some of these big movers and we'll tell you more about them in a moment. So I'm just going to briefly go through this. HKX and the Bloomberg scoop, China's raising scrutiny on outflows, not much reaction there. Treat.com out with earnings this time yesterday, big drop overnight. Are we seeing a big drop here? No, not quite that just yet. Baidu on this transaction, buying YY Live Video, streaming business, 2.1. Shares are doing that. And very, very quickly here, Jiangxi Copper, also on your screens coming shortly. Copper LME is up about 1% on the news we just talked about there with Derek Wallbank in Singapore. The opening bell, Hong Kong, Shanghai, and Shenzhen. You're watching the China Show, just 3 minutes away.
Good morning and welcome back. You're watching the China Show. We are less than a minute down to the open of markets here, and just taking a look, it does look like the Hang Seng is opening perhaps 0.9% higher after, of course, the losses that we saw over Monday and Tuesday opening the week. USD offshore yuan not moving too much. I mean, there has been an interesting story around the yuan really failing to sort of gain ground, Dave, even though we've seen this weakness in the dollar over concerns over the yuan.
Yeah, I think one of the points that our earlier guest from Aberdeen didn't quite get to, but I think it's important because we talked just outside the break, was that the U.S. dollar is a currency that remains a bit in extreme scenarios where you have extremely bearish and extremely bullish. And she thinks right now we're in a Goldilocks place where the dollar is and will come out of favor in favor of the other currencies. Now, of course, that could change any day now, right? Depending on what comes out of the White House and some of the peers and stakeholders there. Right, we're looking at a higher open, as we can see on your screens, in terms of bullish trends. The recent uptrend the last 2.5 months has been enough to push up the math on the 100-day, just about the 50-day moving average. Nothing much as far as the big movers are concerned. We're looking at steel, obviously, and within that, of course, copper, which is the first row, third from the left. Flat in Shanghai, up though here in Hong Kong on the LME contract. So yeah, more on that in a moment, of course. Very quickly, Hong Kong, and the story there is number one with the budget out today. So we'll stay tuned for that, of course. We'll get you a preview in a moment, in about 90 minutes or so. So stay tuned for that. And what they say, particularly on the developers front, right? Apart from that, we're looking at a broad bit across tech. We talked about this Baidu deal, $2.1 billion. Going into live streaming and that new assets being folded into the company. HKX, we'll talk more about this in a moment and we'll tell you why, but yeah, we're looking at that. Jiangxi Copper, we mentioned just copper just there. And earnings, Sinoland and Budweiser are on deck today to report. Budweiser APAC up 6.5% in the early minutes. Right. Just to remind you, the latest on the Alibaba story from the sell side is Bernstein. ADRs outperform. And that really adding to this quite lengthening list right now of sell side becoming more bullish on Bob. And as you can see, our consensus rating on the stock is now at the highest in about a year. It's almost gone vertical. We'll get more, of course, once we hear from the sell side even further. Just in case you're curious what this is, a figure of 1 is effectively all sell. Figure of a perfect 5 is all buy. Alibaba is quite just going into the high fours right now. Right. Other things, we're looking at the funding stresses and demand for credit short-term, overnight, 1 week. Sorry, by the way, before we talk about that, the amount of money coming through in Hong Kong. So 22.5 billion was the figure that we had last week. 22 billion Hong Kong dollars net buying yesterday. Enough for the last 2 sessions on your screens to be part of the top 5 all time in terms of, yes. So in other words, there is a lot of buying taking place amidst these dips we're seeing here in Hong Kong and Hong Kong tech. Okay, very, very quickly on the pressure on the short ends and the funding stresses, we're keeping an eye, well, repo rate for one. Yeah. This could be another one to watch as well. And just to do the math, right, if it's 2.06, if that remains above the level you see bottom of your screens, is indicative really of the funding stresses that you could get from other banks, but not with a central bank. But I'm getting too technical with that.
I mean, The technicalities matter because all of this really is about the PBOC's laser-sharp focus on defending the yuan and the cost of that to the funding cycle, to the liquidity that we're seeing in the banking sector. And as we go into earnings, of course, it's going to be top of mind, particularly as we think about how banks are thinking about tariffs for the next 2, 3, 4 years.
Yeah, absolutely. And it's also all of the listings coming here, what they plan to do with dividends. Do you need that much money sitting outside offshore, I think, is a key question there.
Yes, and exactly. So that question of what it is, whether we need so much cash going offshore. There's a really excellent Bloomberg scoop on the terminal today and on the website. Bloomberg has learned that China is increasingly scrutinizing outbound investments by domestic companies over concerns about capital outflows and depreciation pressure on the yuan. Let's bring in our China correspondent, Min Lo, in Hong Kong. I mean, first, maybe let's just lay out how difficult is it actually for companies to get cash overseas, because of course Chinese firms raising either in the debt markets or equity markets, it's been a key function of Hong Kong's capital markets.
Yeah, so this is part of efforts to further support the yuan again, because we are hearing from sources now that Chinese authorities are asking companies, China-incorporated companies that are looking to list in Hong Kong or have a secondary listing in Hong Kong, they now have to get a no objection indication from SAFE, which is a forex regulator in China, in order to deploy these funds overseas. Otherwise, they'll have to repatriate their share sales proceeds back to mainland China. We're also hearing from sources that authorities are more closely scrutinizing any funds that are sent overseas in the name of direct overseas investments, because the fear here is that companies would fake these transactions in order to move money out of the country. And this comes after the record investment outflows last year, close to $170 billion that flowed out of China from Chinese companies last year. And we know that SAFE in the past had not really been that involved in these stock offerings overseas, including in Hong Kong. But now this is a sort of additional regulatory step that companies have to comply with. They are being asked to update SAFE and other relevant authorities of their process of their share sales overseas. And this comes again as we are just seeing this revival in the IPO pipeline in Hong Kong. We're expecting this very jumbo IPO from CATL coming up that's highly anticipated as well.
Yeah, bankers are already counting their bonuses on that one. Min, what does this have to do with the currency, though?
Well, of course, these measures that I mentioned earlier, they're supposed to help boost the yuan because it's a huge amounts of money that are flowing out of China. And we have seen how the PBOC has been consistently, as you said, laser-sharp focus on supporting the yuan. Of course, there are many other fundamental reasons why the yuan has been depreciating, not just because of these investment outflows, but the interest rate differentials between U.S. and China, the domestic economy, the threat of Trump tariffs. We are also seeing this emerging divergence in the investor sentiments between the U.S. investors and Chinese investors. And it looks like PBOC is now in this holding pattern to wait and see how the external conditions will change, domestic conditions as well. There's the NPC next week, which could be a catalyst for market moves as well. And so they are maybe just reserving the firepower for the right moment and calibrating the right response at the appropriate time.
Min, thank you so much. Min Lo, a China correspondent. One of the things Min mentioned there, of course, is this massive listing that's coming, of course, CATL, and bankers want to get a piece of this, of course. Wall Street bankers, in fact, are racing on that side of the equation here, racing for a slice of this listing here in Hong Kong. That's despite, well, two things. You have lower fees and a U.S. blacklisting. Let's bring in Julia Fioretti, our Asia Equity Capital Markets reporter, to talk us through this. And I guess it would start things off with, obviously it's a big deal, so people are paying attention. But why is competition so fierce, particularly here?
Well, there are a number of reasons. One is that this is the biggest deal that Hong Kong is likely to see in the last 4 years. So there's certainly a scarcity value, and it's extremely important both for revenue, despite the low fees, and for the league table. Another reason is that the onshore market for share sales has largely been shut over the last few years, and that's to prop up the stock market there. And so that means that a lot of Chinese banks have had to focus more intently on deals in Hong Kong because they don't have much to do, basically, in terms of share sales onshore. So that has intensified the competition that we're seeing for deals in Hong Kong. And obviously this sort of is sort of a continuation of a trend that we've seen over many years of Chinese banks increasingly grabbing market share here in Hong Kong from Wall Street banks.
And how important is this deal for Hong Kong itself? Is it a game changer?
It could be. It's super high profile. It's the company is a world leader, obviously, in its sector.
Yeah.
It's probably likely to be. It could well be one of the largest listings globally this year. Obviously, it's hard to say. It's only February, but still, it's up there in terms of deal size. And so, for Hong Kong to be able to get that is obviously hugely significant, given that the IPO market has been so downbeat for the last few years, and only 2 years ago, proceeds had hit a 2-decade low. They recovered, obviously, last year somewhat, but still well below the pre-COVID average.
Okay. Well, keep our eyes peeled. Keep watching that. Bloomberg Asia Equity Capital Capital Markets reporter Julia Fioretti there with the very latest on that CATL deal. There's plenty more ahead. You're watching The China Show. This is Bloomberg.
All right, welcome back. We're just going into the session today, so just in case you're wondering, we're up across Chinese benchmarks. We're running into an Nvidia wall globally, arguably still the most important set of earnings out and about just within the next 24 hours. So interesting, though, as far as the PE goes, and we talked about how Mag 7 as a group entered a correction. You probably saw the headline on Tesla falling below that market cap of about $1 trillion. In Nvidia's case, it's now trading at about 28 times, which is at about the historical average. And it's now trading. So this is effectively the cheapest Nvidia going into an earnings report in about 4 quarters. So what you do with that information is completely up to you. Anyway, at a time, of course, when the world's big tech stocks have been in retreat, let's get more context right now on these earnings with Masahiro Wakasugi, our senior tech analyst, joining us now to talk us through this out of Tokyo. Masahiro, good morning, and thanks for joining us. So what key metrics do you think we'll be needing to pay attention to here today, among the many, many things people watch on NVIDIA?
So from Asian perspective, of course, the revenue should be the most important number. So if I look at the revenue, we are seeing that the revenue growth each quarter is increasing by around 3 to 4, well, maybe $5 billion US every quarter. So say 22, 26, 30, and 35, and the next January quarter consensus revenue is around maybe 38 billion US, and maybe Q1 guidance ending April should be somewhere around 42 billion US. So that kind of number should be quite important. So maybe if that growth magnitude decelerates, maybe viewed as a little bit disappointing. But if they keep that kind of pace, that would be fine. So we see that revenue would be the most important number for the Nvidia earnings.
Masahiro, I mean, Dave made this point earlier that Nvidia earnings might be the most important earnings globally that we are watching, certainly this week. Just lay out which companies in Asia could be most affected by those.
Yes, if we look at the Asian names, of course, SK Hynix would be the very much exposed to the Nvidia business. So their HBM revenue already exceeded 40% of the total DRAM revenue for SK Hynix, and the majority of the SK Hynix HBM going to Nvidia GPU. So I think that the results should affect the SK Hynix business going forward. And of course, Samsung has been supplying the older generation HBM to Nvidia, and I think that Nvidia's revenue portion in China may be another focus because we are seeing that the kind of China export restrictions. So in that case, China customers may be a little bit buying some Nvidia GPU in advance, or maybe delaying, or that kind of a behavior could be another point. And If we look at the GPU-related testers, Advantest has been benefiting from the chip complexity transition at this point. So, and Advantest should be another one. And if I add one more, the Blackwell, Nvidia's Blackwell should be the launching and going forward, and more powerful and advanced cooling system should be necessary for the data center. So in that case, a NIDEX cooling system could have some impact from the Blackwell ramp-up schedule going forward.
A final thought on that, if you could, because we talk about China. The biggest customers for Nvidia, as you know, are probably a couple of big U.S. names, which I won't get into. But are there any signs, effectively, that we're starting to see demand for Blackwell or other chips out of Nvidia starting to soften a little bit?
So far, we have not had very clear sign of the deceleration. As far as I talk to some companies, many companies still want to develop AI, maybe software or LLM or AI applications in a short term. So in that case, even though we have a kind of different type of LLM and such as DeepSeek, we still need a GPU going forward. So at this point, I don't think at this point we see the deceleration of the GPU demand, especially in the near term, I guess.
Okay, Masahiro, thank you so much for breaking down that preview for us. That's Bloomberg Intelligence Senior Technology Analyst Masahiro Wakatsugi. And now to some of the major geopolitical stories we are watching today. Hamas says it has reached an agreement for Palestinian prisoners to be freed by Israel. The group had earlier refused to continue talks for a second phase of the ceasefire until they were freed. Meanwhile, Israel suggests it wants to extend the Gaza ceasefire when it expires this Sunday. But Israel's foreign minister told his European counterparts an extension will not happen without more hostage releases. The UK plans to lift defence spending to 3% of GDP over the next decade amid doubts over US support under President Trump. Prime Minister Keir Starmer outlined the plan and described it as the biggest sustained increase since the end of the Cold War. He says the government will pay for the initial hikes by cutting overseas development spending and won't raise taxes or borrow more.
Yeah, and speaking of defense spending, defense strategies as an investment theme has really paid off a lot for a lot of investors out there, and including when you look at this part of the world in South Korea, where investors have been really ramping up bets there around defense and shipbuilding stocks. In fact, Optimism is being fanned by expectations of a revenue boost for the sector globally on the back of what Rebecca was pointing out there in the UK's instance, of course, more government spending going into their militaries. Let's bring in our Asia Stocks reporter, Yukyung Lee, with a story for us on the Korean front. And yet, Yukyung, talk us through this. Why are defense stocks, and also shipbuilders included, all the rage despite everything else that's going on there domestically in South Korea?
Yes, it might be really surprising to some investors who've been watching the domestic political uncertainties in South Korea that some of the Korean defense and shipbuilders are the best performer this year in Asia. And this sector used to be a little too small, a niche for global investors to take interest in. But I think that's starting to change now. We are seeing the companies like Hanwha Aerospace and Hyundai Rotem jumping more than 100% so far this year during the 2 months of 2025, and that's coming on the back of this earnings optimism. Goldman Sachs analysts have been saying that the Korean defense sector has seen the best fundamental improvements in the earnings per share revision in the past 2 years, and there's still expectations that their earnings will be revised up further, and that comes on the backdrop of potential earnings downgrade in other sectors such as technology and the stretch valuation in other areas. So these are are the sectors that investors are really excited about. And another factor with the shipbuilding especially is that a lot of investors see South Korea shipyards as a safe zone from the tariffs or other geopolitical tensions because of South Korea's place as a key military ally of the United States, and it has some of the world's largest shipbuilders. So now the U.S. is looking to potentially outsource the construction and maintenance of their naval vessels, and South Korea might be a really key place to do that. So those are the factors that investors are watching as how this defense and shipbuilders could be a safe place for them at a time of high uncertainties about the global economy or the earnings downgrade.
Okay, given the outlook for earnings there, for this sort of cohort of names that you've mentioned, are these names, are they still providing good value? Are they getting too expensive?
Yeah, that's a good question. So because so many investors saw this sector as a safe zone since the Trump has taken office, the shipbuilders especially have seen their valuations getting past their historic averages. It looks like some of the investors here are not so comfortable with the valuations level of the shipyards, but they still don't want to take profit yet because they want to watch the Senate bill hanging in the U.S. Senate, and they also want to they don't seem to have a good alternative to rotate their money out of the shipyard or the defense sector. And another factor is that this potential correction in the U.S. tech stocks or other technology stocks in Asia, which have seen sky high valuations, some of the investors think the shipyards and defense could provide a protection against potential correction in the tech space. So even though the valuations seem pretty high, I don't see active profit taking coming soon.
Okay, Yukyung, thank you so much for joining us to break down your latest column. Bloomberg Asia stocks reporter Yukyung Lee there. There's plenty more ahead. You're watching the China Show. This is Bloomberg.
Welcome back. You're watching the China Show. Just a couple of sectors that we've been tracking. There's an earnings theme. Obviously, there's a recovery we're seeing in tech. And just very quickly, though, on the telco space, some of these names were actually up. Well, most of them were up earlier on. As you can see, we've reversed most of those gains right now. In any case, we are getting a lot more policy support, at least announcements here coming out of Premier League urging innovation here as far as the telco sector is concerned. Speaking of earnings, we have Budweiser, APAC, you have Sinoland set to report, and of course the other one that did report already, ASMPT, and as you can see, shares are down 15% at one point last we checked. That's an earnings miss. Fourth quarter net income, as you can see there, just coming in below consensus. Right, on the benchmarks themselves, CSI 300, we are doing slightly better than we did yesterday. Just a very low bar, of course, given the sell-off that we had there. MSCI China, Hang Seng Index now has a 23.5 handle. The Hang Seng Tech Index is recovering about 2.5% from the drop that we had yesterday. So just keep in mind, as far as technicals go, the Hang Seng Index actually closed below the October high yesterday after breaking above that. So I would imagine very, very, very short term, watch that high that we hit back in October as your next level of support. Hang Seng Tech Index, we'll talk more about the rally we're seeing in the likes of Alibaba, Tencent, and the like, but most of your usual names are actually seeing some decent gains in the Wednesday session, about 30 minutes into the session here. Rebecca.
Yeah, keeping an eye on Budweiser actually still. It has reported earnings and quite a big bump up, double digits
yes,
higher. Yeah, 11% so far. Keep watching. Stay with us. You're watching the China Show. Good morning and welcome back to the China Show. We are 30 minutes into today's session. Here's a look at the HSI, and we're just going higher and higher, David. Well over 2% up now. It puts us firmly above the losses that we saw coming into this week, Monday and Tuesday.
Yep. Certainly made up for the aberration, and hopefully an aberration for the bulls that we had on Tuesday as well. Obviously, we're continuing to see some inflows coming through across the Stock Connect. Yesterday, in case you missed the full full day total was 22 billion Hong Kong dollars, which was, I think, within the top five.
Fourth highest
on record. Yeah. So, yeah, take me to Hong Kong. Take me south of the border. Up 2.2 right now. The budget is, we're slated to get that announcement and, of course, that speech coming through out of the finance secretary in about an hour from now. In the meantime, the market's already sort of speculating what the winners will be. Ahead of that, every year we talk about the budget, and every year we talk about property for obvious reasons. Within this too is consumption stocks, right? And do we get the higher tax for the rich, which obviously doesn't affect us, Rebecca, but in case that you fall under that.
It's always wishful thinking.
Yeah, it's a good problem to not have if you think about it.
Yeah, I mean, a big focus this year is going to be trying to figure out the deficit, of course.
Yeah,
We've had the falling revenues from land sales, also from tax revenues. It's been the big question that we've been asking a lot, really, through this year. How are they going to start making up those shortfalls? And now we also, of course, had this tariff US-China threat as well.
Yeah, and that they really have to really make difficult decisions, I guess. We were talking with Christopher Hui, right, a few months back, and this is really one of those times where they really have to pick between some of these difficult sort of levers to pull amidst this broader push, of course, for wealth here in the city, right? You tax the wealthy if you want to do that. That's a tricky conversation to be had. Anyway, I digress. China Tech, big tech in focus as well. Have we shown that yet? There we go. Everything from Baidu, Baba, Tencent, and Xiaomi all seeing a relief rally today. Treasuries is a big focus as well. I think we're down on yields, massively down yesterday. We're seeing a reversal of sorts today. We're down 4 days into going into today. And, of course, the data point overnight was the Conference Board consumer confidence down about 7 points. If that doesn't make sense, 7 points was the biggest absolute drop in terms of points there, going back to 2021. The rest of the region, including, of course, China on the benchmark, U.S. futures are doing quite well. 0.2%. The dollar's flat. And the other thing we want to focus on as well, of course, is the yen, which has been bid along with havens. And not on your screens, we'll talk about this later, is copper. Copper was up 1% last we checked. Anyway.
Yeah. Well, sticking to China markets, that's what we do here.
Yeah.
Let's bring in Marcella Chow, global market strategist at JPMorgan Asset Management. And I just want to pick up on a point that Dave was making about the relief rally we're seeing in China Tech. Your stance on the rally that we've seen, the AI-driven rally, how does this really have legs to continue? If you missed that entry point, is it too late? When's the next buying opportunity?
We do see this time round because it's supported by technological innovation and advancement. So this should be quite supportive to earnings and valuations going forward. But indeed, right now we see that over 80% of the southbound flows probably are initiated by retail investors and also private asset managers. So most of them are quite momentum driven. And if there are more market corrections, that might actually test their endurance and whether there will be further corrections going forward. But we do see actually with this current momentum and the advancement in technology is actually quite supportive going forward. So, and we also are awaiting for more details from, for example, 2 sessions going forward from China. And that might, in the near term, also support both onshore and offshore China sentiment.
Yeah, I was actually going to ask you that, before the DeepSeek moment, the expectation was the 2 sessions would provide the positive catalyst. But now we're up, let's call it 25%. Do you think there is downside risk now going into NPC? Do they have to come up with something really, really big to impress these markets, given how far we've come, because of a separate catalyst altogether?
I'll just add, we rarely see markets rising like this before the NPC as well, just to add to that pressure of downside risk.
To be frank, there is this downside risk that given the market rally, the government officials might be a bit more complacent and believes that they do not need that much of a support. But we do still think a forceful policy stimulus is needed for the market to boost consumer confidence, to make it more sustainable. And we also need more macro data to be supportive. Because lately, we get only a spot of data from, for example, money data and also tourism data, which is quite supportive. But in the near term, we do also need more encouraging macro data from China and a more stable and more predictable U.S.-China trade relations to be the key positive catalyst to support more upside for China market equities.
Yeah, you mentioned just now that the buyers of this concentrated rally in tech have been domestic retail and some of the private funds. How much participation are you seeing from foreign investors?
There have been more questions lately and
more questions than buying?
Yeah,
okay.
and whether it's the right time. But
okay.
There are also queries about, is this the right entry point? And also, they are still probably on the wait and see and a more cautious tone given they are waiting for the 2 sessions to come up. And also, all the uncertainties have been ongoing. That have been also a reason for them to stay on the sidelines.
I mean, I want to put that question to you. Is this the right time for those foreign firms to start dipping their toes back in? And if not now, what might be the trigger that really convinces them and gives them that confidence to come back?
And indeed, actually, the DeepSeek moment after January 27, this low-cost, high productivity tool that emerged from China. And also, given how we did analysis that suggests we saw how Taiwan has been outperforming in 2023 and 2024 because of hard tech, like hardware, semiconductors, etc. But with the recent emergence of DeepSeek, and we see the capability of AI from China and also from Asian regions, we see actually H-share has actually a high proportion with soft tech and software services companies. And that's why the recent outperformance in like Hang Seng or MSCI China is being led by this abundant supply of AI-related service provider in Hong Kong and also in offshore China.
Is that now a risk to the other AI play that has been very popular, which is Mag 7?
We have always advocated how we should broaden out our investment horizon and not just focusing on Magnificent Seven, but more into broadening out to other sectors that also offer, if you are in supportive of this AI thesis, which we continue to, but then we should broaden out and not just focus on, because given how high the valuation is actually quite risky as well. But then we also see how U.S. exceptionalism will likely stay because even though there have been talks that, U.S. exceptionalism is fading, but we see still there's a growth differential across, compare U.S. against, for example, Europe and other emerging markets. There is still the growth differential, and earnings can still deliver. But then it might disappoint the market a bit as we don't expect them to continue to deliver like 20, 30 plus earnings growth. But then they are still actually managed to deliver and support the market. So near term, we believe that we should broaden out the horizon and broaden out our investment universe to not just within Mag 7, but across different sectors within U.S. and also across different geographic locations.
Okay, that's a good point on delivering in terms of earnings. So how are you thinking about China stacking up against other EM and, of course, against India?
These days, actually, India was not as much in investors' focus because of, for example, the GDP and also the growth was actually a bit disappointing. And also, there's still concern about, for example, the valuations issues. But then in terms of the sensitivity to like the ongoing trade tensions, India is actually more resilient. And also because we continue to believe U.S. dollar will likely stay strong. And actually in our analysis, we see that within Asian currencies, in a rising U.S. dollar situation, India markets and also ASEAN markets continue to outperform. So even though there have been less talk for India, we still stay quite constructive in the medium to long term probably.
Just to ask you about macro, if you could get your economist hat on for us. Do you see any path between now and the end of the year where inflation picks up in China? And the opposite, of course, in the U.S. Can we still trust the disinflation process to continue in the United States?
Right now, inflation to increase within China, given now there is the continuous deflation worries, this all depends on whether the domestic demand can pick up and to support the market sentiment and also the consumer spending, which right now is still lacking a bit. So this all depends because we see how, why I was quite bullish on this whole AI theme within China is that if this can indeed promote or boost investment spending or consumer confidence, this can actually kickstart another revival in the investor and also the whole business sentiment to continue to invest and also recover and also the investment sentiment going forward. That can actually provide a big boost compared to just relying on, for example, government supportive measures. So this will be a key positive catalyst if the AI can actually support the whole recovery in China market going forward.
Marcella, thank you so much. Great to speak with you. Marcella Chow there, Global Market Strategist at JPMorgan Asset Management. Okay, speaking of what was supposed to be a quiet morning, we have some breaking lines coming through here. And it's the Chinese president.
Yes. So this is from Xinhua, really saying that it's important to maintain stability across society. And these interesting lines here that have just caught my eye on Xi urging officials essentially to sort of keep calm and carry on, urging folks to continue promoting economic recovery, urging China to address internal and external challenges calmly too. And I mean, this is sort of a tacit reference here, Dave, to, of course, events with the US, to the tariffs that we've seen coming out, and kind of speaks interestingly to the point that we were just discussing with Marcella about this possibility, just a possibility, that officials might be somewhat complacent going into the MPC if they do feel that their industrial policy, the support for AI and innovation that they've spent years plowing into that sector, is actually starting to pay off and can start to offset some of those tariff risks, that they don't need to go in really big and hard when it comes to stimulus.
Yeah, not the risk of not leaning in further into what's worked so far. What's interesting is the change in tone that this might be signaling, and I'm just going to caveat there. And it's important, of course, as context, as Rebecca was pointing out, we are going into the NPC, which is, it's this time next week. So, we are on approach to that. There are, of course, certain events that then lead up to that, like maybe this. We get more context on this. Just to also mention, in case you missed it, because I think this is also important, that statement which came through out of the Ministry of Commerce with the Vice Commerce Minister talking and having a conversation there with some American counterparts there. Myron Brilliant is a former executive vice president at the U.S. Chamber of Commerce, and that seems to be a little more on the more constructive side of things as well. So things to be falling in place. And
yeah, interesting to see that perhaps policymakers feel that they are on fairly steady footing, or perhaps steadier footing than they were, a month or two ago going into the Trump presidency.
Okay, well, that's the story for now, and hope we can just end the show here because I'm fairly encouraging. Any case, not just yet. In fact, coming up on shows, we have the perfect guest to talk us through all these things. Zeban Advisors joins us, and they can really give context what's happening on the ground in financial services, relations between, of course, the two most important economies in the world. Peter Alexander joins us in a couple of minutes to talk us through these key themes. Plenty more ahead, suffice to say, here on The China Show. Right, welcome back. You're watching The China Show. So copper is a story we're obviously in focus today. In case you missed it a few hours back, the U.S. president said it's time for copper to come home, that there is no other place in the world where copper needs to be mined and produced but the United States. I'm paraphrasing there. Copper is up, LME is up 1%. We're not seeing a lot on the contract in Shanghai. Some of the miners, as you can see, are also seeing some upside. Not a lot, not substantial. Let's get more context on the story with President Trump obviously talking about that and the potential maybe of tariffs on copper. Martin Ritchie, our commodities reporter, is with us out of Shanghai. Martin, good morning. And talk to us about, we can talk about the possibilities in a moment, but what did President Trump say?
He said he's going to make the great American copper industry come back home. This is a big day for copper industry and copper markets globally. He said, as you just paraphrased there, that he wants much more copper production in the US, and he has ordered the Commerce Department to investigate all types of copper imports into the US and come back within 270 days, so this could go on for quite a while, and recommend what he should do. But clearly his mind is on tariffs. In social media posts, he said that he was minded to put tariffs on copper. So it looks like he's following steel and aluminum from his first administration with tariffs, using national security grounds to impose tariffs. And we've seen copper prices in New York go up nearly 5% already this morning. So it's big moves all around.
Yeah, I want to pick up on that point about the big moves. I mean, if we do see tariffs coming through, how disruptive or how much volatility does this add to copper markets, commodity markets at large?
We've already seen a lot of volatility in the copper market, just as traders try to anticipate what Trump was going to do. He mentioned copper back in January, then it kind of fell a bit silent, and he unrolled the aluminum and steel tariffs, 25% from March the 12th. So the copper market was trying to gauge what was going to happen next, and you saw this big gap open up between US prices and prices in the rest of the world. There is already copper being shipped to the US to benefit from that price gap. Now, the fact that the investigation could take quite a long time, as I said, up to 270 days, we'll see if it's quicker, but they have to go through the national security investigation first. The fact that that's going to be a longer period than it is for the aluminum and steel tariffs just means that that gap between the prices might last for a bit longer, and you might see traders have a lot more time to ship material over there. But it does also mean that the kind of volatility may be tempered a little bit because everyone has a bit more time to prepare.
Okay. Bloomberg's Martin Ritchie in Shanghai there for us with the very latest on the outlook for Dr. Copper. And now to some of the other major stories that we are following this morning. US Steel and Nippon Steel are reportedly seeking meetings with the Trump administration. News website Semaphore says the CEO of US Steel wants to talk to Vice President J.D. Vance, while Nippon Steel wants to meet with Commerce Secretary Howard Lutnick. No official meetings have been scheduled yet. Nippon Steel on Tuesday reiterated its goal of acquiring US Steel for $14 billion. Japan's minority government has reached a deal with the opposition Japan Innovation Party to pass the annual budget. This clears a major hurdle for Prime Minister Shigeru Ishiba, whose leadership was shaken when the ruling party lost its majority in the lower house, barely a month after he had taken office. The budget includes expanding subsidies for households with high school students and considering cuts to national health insurance costs. And South Korea's impeached President Yoon Suk-yeol says he would dedicate the rest of his term to constitutional reform if returned to power. The Constitutional Court is wrapping up a trial on whether to permanently remove him from office for his short-lived martial law declaration. The ruling could trigger a presidential election within 60 days.
Now let's get more on this week's special coverage here on the drones arms race. It's a contest certainly that stretches to supply chains, which right now are heavily skewed towards China. But there's been a recent push by governments just about across the world here, including in the U.S., to build more distribution channels. Our tech reporter, Annabelle Jewelers, explains how Taiwan wants to become a key base for that production.
Our sights are set on making Taiwan the Asia hub of UAV supply chains for global democracies.
It's a bold vision, but not one without challenges. Taiwan is racing to develop a domestic drone industry capable of defending itself from China. The island also wants to forge partnerships in unmanned aerial vehicles, or UAVs, with the US and its allies. AIDC is a government-backed aerospace company taking a leading role in establishing industry collaboration in Taiwan.
We need the defense localized, the first reason. And the second reason is that I think the drone developed trend is very quickly and a very huge demand.
Yet the island's drone inventory is still relatively small, particularly when compared to that of the Chinese military. This video, which circulated in 2022, shows Taiwanese soldiers throwing rocks at suspected Chinese UAVs on an outlying island. It painted a stark picture of the capability gap.
I think Taiwan might be need what we call the chip and software. The chip means we need for the communication chip, we need for the flight control chip, and we need to have the GPS chip. So those three kinds of chip, I think it's something that we need to build up our technology by ourselves very quickly.
Building up drone stockpiles is no easy task, even if Taiwan is already recognised for its high-tech manufacturing expertise. Among the challenges is economic feasibility, as local UAV manufacturers need international buyers to build at scale and to cut costs. Then there's Taipei's diplomatic isolation imposed by Beijing, which constrains its ability to export advanced weaponry and could also make countries uneasy about supply disruptions in a potential China-Taiwan conflict.
I would worry about the security of that supply chain in the event of hostilities. How much can you rely on it?
And there's also pure business-to-business competition.
A lot of other nations are building these systems, right? I mean, one of them being China, that may wish to supply them around the region in terms of kind of regional suppliers. And then Turkey, when you're looking at kind of more traditional US and NATO allies, Turkey has a massive drone industry. I mean, they're even building drone aircraft carriers. So yeah, there's competition out there, and yeah, they're not alone.
Annabelle Drulers, Bloomberg News.
And for Bloomberg clients, you can catch up on all the interviews, including this special report and more ahead, of course, out of Taiwan special this week on TV Go on your Bloomberg terminals. Also join the conversation, sending us instant messages here. And if you have some burning questions for next guest, Peter Alexander of Zeman Advisors, we're talking all things China-US, financial services, and everything in between. Do send us through. Of course, check it out, TV Go. That's the way you get to us. This is Bloomberg. Right, we're looking at some of the big tech, the rally in big tech on your screens, certainly. Now, the interesting story, which we will unpack for you guys in a minute here, that DeepSeek is reopening some access here, well, access to its AI model, and that's really leading to some buying, incremental buying taking place right now. And not to say that the rally wasn't on solid footing at the open, but it was. But then again, there's more to talk about as far as this, the theme is concerned. XPeng, 6.3%, and of course SMIC, which did catch a strong bid on the other Bloomberg scoop from yesterday, up about 5.3%. So where does this leave the Hang Seng Tech Index, which did see quite a bad day at the office yesterday? And as you can see, we're almost back at the highs that we hit early in the session on Monday, which is February 24th. A little bit more, of course, and we take that out very, very quickly. Crypto, as a risk asset, has been under pressure, down 7% the last 48 hours or so. And that's playing out across some of the crypto-related equity names here in the region. Right, welcome back. We are just going into easing ourselves into the Tokyo lunch break right now, and we're looking at the Nikkei 225 down about 1.1%. As we head into that, the yen is slightly on weaker footing. That's after this, of course, havens across the world, including gold, catching a bit, including the yen, if that's not obvious to you. We're flat across the regional benchmark on the back of, I guess, this sort of push and pull, the bull and bears, between what you're seeing in Japan and, of course, elsewhere. And we'll talk about Hong Kong in a moment and the rally we're seeing here. Right. Japan property stocks, conversations around because of bad data in the U.S. Can the Fed cut more than we thought as recently as Monday? That seems to be at least a buying opportunity right now. And as you can see, some of the real estate plays in Japan are catching a decent bid. today going into the break. Right, Asia X, Japan X, China, across sector groups, we're mixed on sectors. We're flat on the benchmark. We talked about that. Now, as far as the Hong Kong market goes, I'll make this very, very quick. We're seeing quite a rally taking place right now. The southbound flows across the Stock Connect has really been one indicator we've been following very closely, as a lot of the buying and support into the market has really been across the Stock Connect. I apologize if the subtitle is getting truncated there, but we want to make a point, so we're going at a big font size here. 5 billion Hong Kong dollars so far has been purchased across the Stock Connect so far in the first hour of trade. And just for context, that's almost a quarter of the all-time high that we saw back in 2021. And you know what? We're an hour in, so the runway's longer on this one.
Well, talking about runway and what might be giving a little bit of an extra boost.
Absolutely.
DeepSeek has reopened access to its core programming interface after a nearly 3-week suspension, resuming a service key to wider adoption of its AI model. Let's bring in our China correspondent, Min Lo here. Just lay out what we know so far and why it's potentially so important.
Yeah, it's a very good news because DeepSeek is essentially allowing customers now to resume topping up credits in order to access its core programming interface. And this core programming interface is a sort of a set of rules and protocols that allows software to talk to each other, basically. So it's key to wider adoption of this AI model. And it was paused for several weeks when the app basically shot to fame and there was a spike in users, and that led to some capacity outages. A DeepSeek representative had said, from what we have seen in a company-verified group chat on WeChat, that there will still be possibilities of strained servers during daytime, and that points to the challenges that DeepSeek faces in having to bolster its infrastructure amid this broader environment where the U.S. has been clamping down on Chinese access to these advanced semiconductors and Nvidia chips. And DeepSeek is also resuming this service on the same day that Alibaba is revealing its latest AI model, the QWQ Max. And that really also underscores how intense this competition is in the AI space, because if you recall, Alibaba also revealed its previous model just days after DeepSeek launched its app. So it's a very intense competition here. Alibaba also announcing a $53 billion investment over the next 3 years into the AI and cloud computing space. And at the same time, DeepSeek last week saying it plans to release key code and data to the public. That's quite an unusual step to share more of its core technology to the public compared to its U.S. rivals like OpenAI. And again, possibly going to escalate that tech race even further as U.S. investment restrictions and chip restrictions that Trump has been proposing is just heating up as well.
Min, thank you so much for the latest here on what's driving the rally right now. Min Lo, a China correspondent there. Okay, speaking of China, let's take certainly the DeepSeek part of the conversation. There's the NPC that takes place this time next week amidst the backdrop really of U.S.-China tensions remaining, despite, of course, this lull, may be quite high. Who knows what the future holds here between what President Trump is saying and what he might eventually do here as it pertains to tariffs in China. Let's make sense of this and head to Shanghai. And Peter Alexander is with us, founder and managing director at consultancy firm Zeman Advisors. Peter, as always, a pleasure to have you on the show, and good morning. If I look at let's start with Donald Trump, and certainly let's call it progress he's made with the aggressive stance he started off with others, like Mexico and Canada. We know that they're starting to look into what Trump is asking. He's also had quite a series of aggressive asks of Ukraine, which we understand President Zelensky might be headed, according to Reuters, to meet him on Friday, and might they talk about access to minerals. The reason I bring those two instances up is, do you think the over-aggressive stance that he's put up on those fronts will work in the context of Beijing?
Absolutely not. And I feel pretty confident in being able to stress it as such. And I think the best way to try and encapsulate the whole situation right now is you can't strong-arm China, or at least the United States can. And in fact, I think strong-arming tactics not only won't work, they'll probably end up being very counterproductive. Because if you do look at all of the other counterparties that the Trump administration has already had conversations with, again, everybody from Mexico, the EU, you name it, it's arguably accurate to state that in each and every one of those cases, the United States has some degree of leverage over those counterparties. What leverage does the United States have over China? You know, they always say, oh, access to our markets, and, you know, the Chinese economy is on the verge of collapse and they desperately need, you know, exports and so on and so forth. But ultimately, you know, when we look at the dynamics, especially in manufacturing, what we have right now is a situation where the United States actually needs China for a host of not just end goods, but also raw materials. And I think to put a good cap on this point, you know, go back 5 years ago, almost to the day, David, when, you know, COVID jumped from China and landed in other parts of the world, there was a mad scramble for PPE. And at that time, all of the protective equipment was being manufactured in China. And China said, you're going to have to wait your turn. We're going to produce it for ourselves locally. That was 5 years ago. And I'm hard pressed to really understand what actions have actually been taken to be able to alleviate the dependencies on China as a manufacturing you know, center of the world.
Peter, to your point that the US can't strong-arm China, would you characterize Trump as more hawkish this second time around? And I suppose really importantly, do you see a gap between his stance and that of his cabinet? Are there hawks on his cabinet who might want to go further than he does when it comes to Beijing?
Oh, I don't think that's even open to debate. I do believe, much like the common consensus has said, Trump is transactional. He's looking for some sort of deal. But again, very much unlike everything that we have seen up to this point in terms of the foreign policy agenda items, everybody's pretty much been on board with what it is that Trump, the man, is looking to achieve. China is completely different. I mean, almost everybody, with the exception of, I guess, his advisor, Elon Musk, have demonstrated over the last decade to be extremely hawkish on China. And then at the same time, you have to keep in mind we have Congress. I mean, back at the end of January, the House of Representatives introduced a bill that would effectively totally rescind most favored nation status for the Chinese. So this could be the first time that Donald Trump is going to, if he looks to have some form of so-called grand bargain, he's going to have to run up against his congressional leadership on the Republican side. And I don't think they're going to be all that happy of any acquiescence to China. And that's going to be a headwind for him, I think.
So what's the advice if you had Donald Trump's ear? You're familiar with the dynamics. What advice would you give him? And what is a realistic ask?
Well, I think the most important element is to recognize that a lot has changed over the last 5 years since China and Donald Trump, as president, last were engaging in some form of negotiation. And over that time, China has aggressively worked on addressing any and all, call them attack vectors. You know, the other day we saw, again, President Trump coming out saying, you know, American investors, they can't, you know, allocate capital to China. They're not really allocating capital that much to begin with. So the world is a very big place. And my outlook is that all China genuinely is looking for is two things. One, to be accepted as a peer, not rival, but just a peer. And two, to be able to exert its own sphere of influence throughout Asia. Now, clearly, that would not come as an interesting or helpful point of view for the likes of Korea, Japan, especially Taiwan. But we have to keep in mind, I mean, America right now is fiscally bankrupt. They don't have the ability to fight a bunch of, not necessarily wars, but antagonize various counterparties. So at some point, Trump and Xi Jinping, I think, are going to have to sit down and, you know, this might be too aggressive, but I think it's accurate. How is it that they're going to be able to divvy up the world in terms of spheres of influence? That's really, I think, the end game. And if it's not going to be that, and again, to the previous question about the China hawks in D.C. and well beyond D.C. America has, in my opinion, been itching for a fight with China. China hasn't taken the bait. But there are sort of two realities that we're heading towards. I'm hoping it's the one where an agreement can be made where the United States and China can peacefully coexist.
Peter, you've done a lot of work sort of breaking down Trump's actual policies, including the America First memo. And I want to get into the weeds a little bit with you. We did have these lines about scrapping the 1980s tax accord with China. I want to ask you what the impact would be and also how you advise firms in the light of that possibility.
Look, I think it has as much to do with capital flows more than anything else. And the real question that needs to be asked is, over the last several years, how much actual capital has been flowing from the United States into China and vice versa? And it has been reduced to not a great amount. So when you're talking about issues with regards to taxes and the like, it's going to be something, number one, that is issue specific to an individual organization that may or may not be sort of operating in that sphere. And I'm not a tax accountant, so I would be remiss if I didn't sort of say I would not be the best person to talk to about that. But overall, I think it's the message that the Trump administration is sending more than the details of exactly what was in that memo. And again, and you can see this over the course of the last 2 weeks, right? Day after day, something new is coming out with regard to Trump trying to create call it a term sheet that he wants to build that he can go in to negotiate with China. And I think what is fascinating is that over the last week, we haven't heard much from China in terms of any potential retaliatory efforts. Whenever China is this quiet, I get a little bit concerned.
It seems that they're focused, Peter, on leveling up themselves. And the reason I bring that up, one of the, and who knows if it was a deliberate response or not, or coincidence, when we were looking for a possible response out of China, DeepSeek happened. There's no better response to your ex than looking good, as they say, right? And there's no better position to go into negotiations than fixing your own house. And, there's a bull market taking place in tech, early green shoots, I caveat early green shoots in the housing market. What's your sense of what's going on the ground there in Shanghai? And whether or not this is, in fact, sort of the best strategy to deal with a peer, in your view, is to simply make your house stronger?
Yeah, I mean, it's been pretty fascinating because I think there's an interesting element that's been overlooked in all of these countervailing, trends that have been going on over the last several weeks. And that is, there's been an interesting, dare I say, soft power, but, an elevation within China. It started really with, you remember when Xiaohongshu was the talk of the town, just a few weeks ago. Red Note was where all these TikTok refugees went. And that really opened the eyes to a lot of global citizens, if you will, to see what China really was like. And, that was then followed up by DeepSeek. Now we have, Nvidia operating or coming in as like the best performing animated film. This has instilled a degree of positive, and I'm going to say relatively so, positive sentiment here locally. By no means is sentiment at the household level, firing on all cylinders. Far from it. But I can confidently say that, sentiment is well past peak pessimism. And yet, we continue to see it, just as your previous reporter mentioned, talking about DeepSeek continuing to open up its code potentially, but going back and allowing the API to run. I did not have, as we like to say, on my bingo card, that China was going to be, the one ruling over open source AI, while the United States is throwing billions and billions for a closed source system. And the dynamics have just shifted dramatically over the last month.
Peter, I mean, we spent almost this entire conversation really talking about the US and China, particularly when it comes to Trump and tariffs. But of course, we also have South Korea imposing steel tariffs on China. We have Vietnam imposing steel tariffs on China. We have Mexico potentially going to impose tariffs on all Chinese imports in order to do a deal with the US. So I want to ask to what extent you think that we're slightly missing the point in terms of those risks, and in terms of sort of Dave's point about, it never looks bad to impress and be kind of strengthen your house in front of your ex. Are we sort of focusing on the wrong counterparties here?
No, I mean, I understand why you would have, allies trying to, take what would appear to be action that the Trump administration would view as positive. I mean, somewhat as an aside, I mean, Apple announcing what, $500 billion investment, in the United States or what have you. I mean, we're seeing this across the board. I'm a little bit suspect. I'll believe these things when they actually happen. But at the same time, China's not just sitting by the wayside, watching these events unfold. They're engaging with their counterparts in Korea and Japan and elsewhere, saying things like, we, A, are in the region together, and B, do you really want to tie your entire wagon to the United States? They haven't really been, unfortunately. And again, this is coming from a red-blooded American. I want nothing but the best. This is what I strive for with regard to my civic duty as an American. But, China has an argument to be made to say, look, we are all within the Asia-Pac region. The United States has demonstrated that, they're a bit of a bully when it comes to what they want. Rules for thee, not for me type of environment. And quite frankly, this is pretty much what led to the rise of the global South. So you can have statements from various governments within the region, how they actually get enacted, or whatever carve-outs might be made or exemptions might be made. I think the devil is always in the details.
Okay, devil's in the details. Peter Alexander, founder and managing director at Zeben Advisors. There's plenty more ahead. Stay with us. This is Bloomberg. Good morning. You're watching The China Show. Hong Kong Financial Secretary Paul Chan will unveil the city's budget plan today. Our Asia economics correspondent Katia Dmitrieva is here. And also with us is Bloomberg Intelligence senior analyst Patrick Wong. Katia, let's start with you. What are the highlights that we're looking for from the budget? And really, what are the options for policymakers here?
Well, it's a very different picture than this time last year. Last year we had a lot of new real estate policies unveiled, a lot of fiscal stimulus, a lot of spending, a lot of excitement, frankly. And this year we're looking at a very different fiscal picture and a very different message from policymakers. So far what we've heard is authorities really trying to find money. They're trying to find places, whether it's elderly and their subsidies for public transit, or it's something like legalizing sports betting for basketball specifically, which is not currently legal. So they're trying to find all of these avenues to try to shore up what is going to be the third time in about 4 years that they're going to be in the red.
Yeah, one of the issues, the remaining issue is really the state of the property market, land sales, the key source of revenue. And what can we expect this time around, Patrick, as far as support measures for property?
Yeah, exactly. The challenge right now is the land sales is not doing really well so far. And then I think that is also several ways to help the government to improve the sentiment here, right? For example, I think the developers, why they don't buy land, right, is because of that, right? They can't sell too much, right, in terms of the residential apartments. So, of course, last year, I think that is the opportunities that we relaxed everything, right, in terms of stamp duty cut, everything happening. But this time around, I think the government may also do we have the capital investment engine scheme that relaxed a little bit in the policy address in October that allow the residential purchase to be included. So that may also be something that the government may further relax, right? Because it's only applied to something 15 million Hong Kong for those luxury apartments currently. So that may lower the barrier, right? That will also help boost the residential purchases by overseas or mainlanders coming to Hong Kong to invest in Hong Kong. I think that's the most important thing, to attract more money to invest in Hong Kong, so that will also drive the government revenue.
Okay, team, thank you so much. Okay, lots to unpack, and we'll find out in a couple of minutes exactly what to unpack, of course, just an expectations they're going into. Of course, again, a very key budget here out of Hong Kong. Katya Dimitrieva there, of course, our economics correspondent, and of course on property, Patrick Wong out of Bloomberg Intelligence here. Okay, we're just counting down to that as well. Just if all goes to plan, just under 9 minutes away from that. Plus a look at some of the big movers across these markets going into the last few minutes of the China show today. Right, just running you through some sectors we're tracking here as we wrap up the show today. So robotic stocks in focus, Unitree releasing its kung fu robots, really giving, kicking some of these prices up to the upside right now. Also, speaking of tech here, also quite important is this rally that's resuming, in fact, gaining a lot more momentum. We talked about DeepSeek and the development. In case you missed that, of course, you can scroll back in TV Go and, of course, catch, of course, the latest on the Bloomberg terminal. But as you can see, substantial gains. Alibaba's up 6%. Right. Now, where does this now place us as far as the sort of big picture on the Hang Seng Tech Index? Peaked on Monday, relatively speaking, dipped, and the last few minutes has actually now seen us overtake and resume this uptrend and completely reversing all the weakness we've had on Tuesday. Right. Now, going into the Hong Kong budget, just very quickly, on one side of your screens will be, of course, the market iteration of that. And as you can see, Hang Seng Property in focus, Hang Seng Composite, which is the broader read of the markets. And, of course, here's the sort of the math has to work conundrum. And we'll get more details how the Hong Kong government plans to make the math work. The last few years or so has really seen a slowdown in revenue, an uptick as far as expenses go because of obviously all the challenges there. And it's been more red than green of late. And how do they make the math work? We'll hear from Paul Chan in a couple of minutes.
Yep, stay with us. Thanks, Dave. You're watching
Thank you,
the China
Rebecca.
Show.